We cover all this and more in our quarterly write-up, but we wanted to share some quick thoughts about what we've all experienced so far this year in financial markets, as well as a bit of what lies ahead of us. Starting with fixed income or bonds. After a big rally into the end of last year, they've struggled to really gain much ground this year. While inflation continues to come down, it's not come down as fast or as far as many expected. And that has kept the Fed from cutting interest rates like many had anticipated, and ultimately kept bonds relatively flat for the past 6 months. Despite their lackluster results, we remain optimistic on bonds going forward. Returns in the short term are typically the result of fluctuations in interest rates, but longer-term returns track the overall yield levels of the bonds you are buying, and those yield levels today are attractive. So our message to bond investors is simply to stay the course. Unlike with fixed income, stocks thankfully maintained their positive momentum from the end of last year. After a strong, fairly evenly distributed start to the year, we saw much more dispersion in the second quarter. As you can see, most major segments remain solidly positive on the year, but only US large growth and emerging market stocks maintained their momentum. Fortunately, growth in those markets was enough to mean a positive quarter overall for the global equity benchmark and for most investors. Markets being up overall happened despite some of what we saw with inflation and interest rates, where developments could easily have weighed more heavily on stocks. Equity markets were able to overcome some of those headwinds, though, due to solid earnings growth, particularly in some of the mega-cap tech names, and the increased likelihood of an economic soft landing here in the US. Going forward, we remain constructive on equities, which is to say that valuations for most segments of the market aren't necessarily cheap, but they are reasonable or fair. The one outlier to that continues to be large cap growth stocks in the US, where valuations skew to being a bit expensive. Overall though, we'd say most market valuations remain at a level that is encouraging, something that hasn't been the case for much of the past 10 to 15 years. Looking ahead, we know the two main storylines for bonds and stocks are going to be interest rates and the November election. So let's jump to each of those briefly. With regard to interest rates, to us, obsessing over when exactly the Fed will start cutting rates is a bit like missing the forest for the trees. That's not to say the Fed's first rate cut won't be important or even a positive short-term catalyst for markets, but it may also be somewhat anticlimactic. After all, over the last 8 months, the equity market, fueled in large part by rate cut expectations, has already rallied more than 25%. With regard to the upcoming election season, our overriding message to investors is simply to stick to your long-term investing plan. Elections can be emotional. It can be very tempting to try and anticipate who will win and what will happen to the market as a result. But as discussed at length last quarter, the economy and markets have done well under the leadership of both political parties. And what tends to be the real driver of market returns is the economy and valuations. Two things that at this point in time, to us, look favorable. As always, thank you for watching. If you have questions or would like to talk about your personal wealth management needs, please contact us at the number or email shown at the close of this video.